Thank you all for joining.
Okay, hi everyone, and welcome to today's webinar. My name is Renana Shvartzvald. I'm head of Impact at Bridges Israel, and I'll be hosting today's webinar on current trends and tools for impact management and measurement. And before we kick off, some housekeeping notes. So first, this webinar is recorded and will be shared with you and available in the relevant platforms. And during the presentations, please, we encourage you to use the Q&A chat box to present questions to our speakers. We'll make sure to have time for questions at the end. Today's webinar is part of the Impact Management and Measurement course that is a collaboration between the KAYAMA Center at Haifa University and the Israeli Forum for Impact Economy. We'll begin with a short intro to the organizations behind it from Rita and Hila.
Thank you, Renana. Yes, good afternoon, everybody. So KAYAMA Center for Executive Education on Social Innovation and Impact Entrepreneurship is essentially a startup. We've only been live for less than a year. It has been established last September. And it's a unique academic forum that strives to bring together different perspectives, different theories, different communities of practice that deal with the question of social innovation and also ask some of the critical questions of how to move forward. Hila, maybe if you can just move the slide. Yes, perfect. So essentially what we do a lot of training. It's executive education. It's part of the name. But the idea is not to keep it just academic education. It's cross-sectoral, cross-disciplinary, and cross issues education, dealing with emerging trends and phenomena of practical aspirations of how do we bring this community of doing good forward. There are several courses going on. One of the courses that is currently being held is the Impact Management and Measurement. And as Renana mentioned, this webinar is part of the course. We will be happy to share a link to KAYAMA if you are interested to learn a little bit more about the activities and the different courses that are currently in place or that will be starting in the next academic year. And I think that's about it.
Thank you, Rita. I will present the Israeli Forum for Impact Economy. Thank you, first of all, everyone for coming today, and thank you, Renana, for hosting this event. The Israeli Forum for Impact Economy, IFIE, is an Israeli NGO and a multi-sector group of Israeli leaders committed to ensuring a continued economic growth and prosperity through the adoption of an impact-driven economy in Israel that also provides solutions to global challenges. The IFIE is the Israeli National Advisory Board to the GSG, the Global Steering Group for Impact Investing, chaired by Sir Ronald Cohen. The GSG is a global independent organization that provides now a network of about 33 countries and counting, which all derive impact investing and impact economy in their own countries. And what we do is we connect, convene, and catalyze partnerships with organizations and entities through our 5 pillars of strategy, which are policy, supply of capital, demand for capital, IMM, and awareness. In each section, we do have programs and projects, and one of them is the IMM course together with KAYAMA. And we are happy to have everyone here today. So thank you for the stage. You're on mute, Renana.
Yeah, right. So thank you, Rita and Hila. Let's move on to our main event of today. So as many of you know, the concept of social impact measurement is actually not that new. Environmental economics and the concept of externalities is studied for decades. And we know that impact evaluation is practiced in the context of governmental or philanthropic programs for quite a time. But with the growth of responsible and impact investing, and in general, the emergence of what we call stakeholders economy, we needed impact measurement solutions that are relevant also in the context of business and financial activities. And specifically, the need was for actionable impact tools and information that can help guide capital flow into the most impactful activities. And naturally, as this industry evolves, we saw and we still see the proliferation of tools, standards, frameworks, indicators, softwares, service providers, and of course, multiple reports on the field in the subject. And building on this rich know-how, we can now recognize two forces, or if you'd like, two trends in the field that are becoming evident today. So first, there is a growing need for convergence. And when I say convergence, I mean the need to understand how all the practices coexist and what are the joint fundamentals. But I also mean convergence in the sense of converging the financial and the impact management, and also better understanding how they interact. And on the other hand, though, we see a growing need for increased sophistication and I would say accountability in this practice. And this is evidenced both in terms of technological solutions, the level of expertise needed, and the level of science that is now being harnessed into the process. And generally, the growing understanding that impact management is becoming a profession. So if I'll summarize it in a way, we're trying to make things simpler and more complicated at the same time. And with this introduction, the purpose of this webinar today is to introduce you with three leading initiatives in the impact measurement and management field, which will be presented by our distinguished guest speakers. So our panelists will share their work and will demonstrate these forces of convergence and sophistication in impact management. And I'm excited to have you with us today, Rob Zochowski. Rob is Program Director and Senior Researcher at the Impact Weighted Account Project at Harvard Business School. Joe Fackler, Platform Manager at the Impact Management Platform, and Igal Avrahami, Senior Analyst at Sustainalytics and a member of the Corporate ESG Insight team. First, thank you guys very much for joining us today. And we'll start with Rob, who will present the Impact Weighted Account initiatives, the drivers for establishing it, and what I think are some eye-opening research results. Rob, the floor is yours.
Wonderful. Thanks for having me. And I'm leaving sort of the navigation panel up here just because I'm going to be skipping around a little bit. You'll get the full set of slides as a PDF version as I follow up. But just wanted to sort of take you through our research and our reason for existing and again to the organizers, thanks very much for having me. So the Impact Weighted Accounts Initiative was set up in 2019 with the goal of driving creation of financial accounts that reflect a company's financial, social, and environmental performance. And our ambition is really to create accounting statements that transparently capture external impacts in a way that drives investor and managerial decision-making, right? And so this represents a little bit of a phase change from sort of the existing way in which we account for value, right? Usually, you know, the big quarterly press releases on the earnings, the financial earnings, you receive a lot less fanfare, if any, when the firm releases their annual sustainability report, right? And so, and we think there's a few reasons for this, right? Sort of in addition, and challenges that need to be overcome that impact weighted accounting does, right? So ESG traditional measurements usually look at inputs and activities rather than outcomes and impacts, right?
Sorry, Rob.
Yes.
Just gonna interrupt you. If you can share the slide on a full screen.
Oh, okay, got it. Let me do that. Slideshow, current slide. How's that? Better? Wonderful. Sorry about that. So ESG, so we did a review when we first started sort of all the major reporting schemes, and over 90% were inputs and activities, right? They're easier for companies to track, right? And so it's really not surprising, and yet to really understand how people are being affected and other stakeholders, we really need to move down that causal linkage, right, into impact and outcomes to really understand the drivers, right? These are also sort of there's less standardization, although, right, I will say the efforts of Joe and the IMM and you know, the ISSB are making substantial changes here, but it is, I should still say, right, it is still hard to compare an environmental impact or a social impact that are denominated in sort of the separate domain sort of metrics, right? And frankly, it's a lot of times, right, you could do a sub PhD in any one of those, sort of denominations, and yet most board members and investment professionals don't have anywhere near that depth of understanding, right? And so to ask them to make a quick decision on an environmental impact or a human capital impact, right? When I see a company, or when one sees a company report their GHG emissions, right? The question, is that a lot? Is that a little, right? We're helped when you are able to compare it to a science-based target. But we do live in a world of finite resources. And so to ensure that we are maximizing our positive impact and minimizing our negative impact in any given year or decision, denominating that in terms of monetary value is more intuitive, right? And so moving on to the left side or the right side here, right? To move from inputs and activities, we are using impact pathways and monetization factors to capture the different sources of impact. With intuitive currency units, these can be meaningfully aggregated and compared. I put a big star, right? We have a public consultation launching next Thursday with the Impact Economy Foundation to talk about the method, the ethics of aggregation, what can be aggregated, what absolutely cannot be aggregated. It's very easy to say a positive plus a negative is a smaller positive. And yet in the goal of transparency, which is a key underlying value of ours, we have a number of ethical rules for that. And our goal and our North Star has been to use publicly available methodologies and data in order to promote our research. So all the research that you will see has been gathered from sort of the public domain. We have not gotten sort of internal company data. And that's important because we believe investors are the ones that will really, really drive this change. They're the most interested in it. That's not to say there are not select companies, but companies usually view this disclosure as risk. Although we are seeing companies use this for internal decision making, right? And so just a few examples. The Australian Pension Fund is examining the monetized environmental and employment impacts of its most sustainable fund as a tool for capital allocation, stewardship, and advocacy. Eisai Co. Is a Tokyo-based pharmaceutical company that has adopted our employment impact weighted accounting as a tool to analyze and communicate their performance. In civil society, the Fresno Economic Development Corporation is actually building impact weighted accounts into their scorecard for corporates as a way to make the economy more inclusive and change the lens of economic development decision making. So not just offering sort of blanket tax breaks or tax deductions, but actually making those contingent upon a certain minimum threshold of performance. And so they're using that. So we think that this can be helpful to lots of different elements of society here. We've done our methodology in 3 buckets, and I'll take you through some of our results, but we've divided it from the environment, impact from the organization's operations on the environment, the product, the impact on society and customers from product use, and then employment, impact of organizations on their employees. And we would extend environment and employment up the supply chain. The just biggest challenge is always data, getting that. Again, just to talk a little bit more about how it works, right? Identifying key impact dimensions, right? What is sort of a material, and by material, I'm referring to, we take the double materiality perspective. What are the material impacts? How can we measure those? What are the relevant measures from the company? And then what is the impact pathway? So, and it's usually just a multiplication element from that. There's usually some attribution questions, but it's actually a relatively clear process from this. this is just, I'll skip this in the interest of time, but here it is to dive a little bit deeper right into how we would do this for an employment impact. So what can be learned? So from our environmental methodology, right, we analyzed over 2,500 companies across, I think, 12 years. And we found, not surprisingly, 53% of the variation that we look at in terms of, and this is scaled version. So, well, 53% of the variation is due to industry effects, right? Not surprising, but importantly, 36% of the variation that we see is actually attributed to firm-specific factors, right? And that's important as we go through some of this, right? I'll just describe this chart here really quickly. The blue bars are, and it's a log scale. So it kind of gives you a sense for magnitude if you're not familiar with log scaling, and normalizes it in some way. And we're showing this as a percentage, so environmental damage over operating income. That's because you would naturally expect larger firms to have larger environmental footprints. And so what we're trying to get a sense of is like efficiency of pollution in some way, right? And so, and then the blue line, or the orange line rather, is the interquartile differences within that industry, right? And so that line is, the blue line is really showing, right, the 53% of variation, but the orange line is really teasing out that firm-specific effect. So I don't think it's a surprise to everybody, right? Construction materials is hugely environmentally intensive, right? As are airlines, you know, power, and metals and mining. But what it actually shows you, right, those are actually critical, right? One school of thought could say, well, you just divest from that, right? But we all need to live in homes. We all need to repair our homes and maintain those homes, right? We, you know, do have a certain amount of discretionary travel. Metals and mining, we are all using the results of metals and mining in our computers to log into this, right? And so, but what it actually is showing is that you can stay invested in those, right? The orange line, you know, the significantly sort of high element, you know, interquartile differences in these intensive industries is actually showing us we can actually be much more specific and granular about sort of investing in those sectors, but being conscious of the sort of the decisions that are being made at the company, and that drives significant performance. So, right, and we are, yeah, this is just showing the same exact things. This is showing, oh, sorry. So then this is the same chart effectively, but for employment, right? So we have looked at you know, employment. This is, instead of showing logged intensity, it's actually showing on the left side, it's showing impact per employee, dollars of impact. Again, you do see, you know, fairly high, especially within certain industries, fairly high interquartile differences, suggesting that analysis and using this methodology, you can parse differences. I will skip this one here. We are also finding that in the environmental space, particularly, there are significant negative implications on valuation multiples across industries, right? And so this is showing there's a substantial coefficient for right, price reduction for price to book value, especially within these sectors. We're showing the largest ones. So not only is this calculable, but it actually is feeding into market forces here. And then in employment impact intensity, there's significant variation across industries. It does increase with firm size, and impact intensity for employment. So higher amounts of impact per employees is positively associated with firm value, and higher impact intensity is negatively sort of reduces net turnover. I'm just going to skip these because I want to get through it all, and I know I have a lot of other people. So product impact is the last feature, right? And when we are also, so product impact is a little bit different, right? Because there's so much heterogeneity among different types of products. Many stores, if you go into a home improvement store in the US, here we have Home Depot. I'm not sure whether that sort of character, goes, but, they have 100,000 products, right, in any given store, and they are all very, very different. And so in order to handle this, what we did was we said, what are some key buckets that are mutually exclusive and comprehensive, what the consultants would refer to as NICE. And so we've come up with a high-level framework that then draws upon it for each different product area, right? You would actually use certain different indicators to measure that, but those high-level buckets are sort of, affordability, access to underserved, health and safety, the effectiveness of the product, whether it's a basic need, whether it's optionality, is it an addictive product or not? What is the environmental impacts of using that product, and what's the end of life recyclability, right? And so we actually see, a number of companies are driving huge amounts of positive impact, right? Telefonica, because of where it operates, is driving a huge amount, over 368% of EBITDA is our calculated product impact. Meanwhile, it can also be a major missed opportunity. So it is another way for firms to distinguish themselves per our research. And so just a little bit on the path forward. In December, the G7 Impact Task Force wholeheartedly endorsed impact monetization, with the caveat, right, that it needs a lot of development. It needs a huge amount of collaboration, consensus building, et cetera. And so they recommended that G7 countries and their partners collaborate with the private sector, standard setters, and academia on approaches to impact valuation. And so that is really what I'm spending my time doing right now, is really scoping those different sort of areas of collaboration, who needs to be brought into that conversation to really get this going by the mandate of 2025. So that is it for me.
Thank you very much, Rob. We do have a couple of questions, but we'll leave them for the end. I will say that for those of you who are interested in the details of the methodology, I highly recommend reading the papers that explains it to the letter. So highly recommended. So if the impact-weighted account is an example for converging financial and impact accounts, and now we'll focus on the concept of converging all the existing practices into one framework that allows practitioners to better understand the fundamentals of impact management. Joe will give us a tour on the impact management platform. And Joe, perhaps to make things clear for everyone, and specifically for those in the audience that are familiar with the impact management project, would you also please share the line of events that led up to the launch of the platform in November 2021 and how it is related to the IMP?
Yes, we'd be very happy to do that. Thank you, Renana. Hi, everyone. It's good to see so many of you today. And I believe it will be Hila who will be taking us through the slides. So thank you so much. Yes, to your point, Renana, I would love to share firstly an overview of what the impact management platform is, but also specifically what is it that got us to this point. As mentioned, I am the platform manager for the impact management platform, which is really overseeing the day-to-day activities and functions of this initiative, which is a collaboration of several organizations that are working together to mainstream the practice of impact management. And then previously, I was also at the Impact Management Project, so happy to kind of explain a little bit of the timeline. But if we just go to the next slide, please, I just wanted to share a few key bits of context that provide, really an overview as to why there is increasing attention paid to the role of impact management. And so the first one here is that there is this groundswell of demand from stakeholders to better understand their long-term contribution to sustainable development goals, or really actually just looking at the sustainability of their business. So this is about saying businesses want to do better, but they're just not sure how. This is a really overwhelming challenge. I'm sure many of you have heard about this term, the alphabet soup, all of these different acronyms that provide the standards and the guidance and the frameworks and the tools, and they're all incredibly helpful, but the soup basically means how do they all fit together and how can they be used by practitioners. So that's the first point. The second point is that, you know, we then have large mainstream investors that are increasingly integrating sustainability information into their investment decisions, and they're calling for improved disclosure and transparency. So this is to understand which sustainability matters are really affecting the value of their enterprise so that they can make more informed and integrated decisions. To the next point, thank you. So this is really saying that in response to those calls and this growing sense of demand, there's really been a sense of stepping up from the regulators and accounting standard setters to, you know, really understand what is their remit and how do they ensure that, you know, they can contribute to the sense of improved transparency across organizations. And so really the aim here was to mainstream the practice of impact management, and alongside that, I guess that mandatory set of guidance, we also wanted to look at the voluntary set of guidance and really what does that mean. And so that is why in November 2021, the impact management platform itself launched to really carry out this aim of mainstreaming the practice of impact management. They are together the holders of the leading voluntary standards and guidance and frameworks that serve a comprehensive part of the market and you know, internationally as well. So from investors and financial institutions, but to enterprises themselves, really looking at how across practice, performance and benchmarking, they can articulate to practitioners really how to engage with their content and how does this all fit together. On to the next slide, please. Thank you. So I just wanted to show who these organizations are. These are really the original members of the structured network, which was formerly facilitated by the Impact Management Project. So just a little word on the Impact Management Project. It was a nonprofit initiative that was set up in 2016 to really clarify for practitioners really what are the best practices in impact measurement and management, which is how it came up with this set of impact management norms that it built in consensus with over 2,000 practitioners. But it actually went beyond those set of best practices to actually facilitate international providers of standards and guidance for impact management. And so that's what led to the creation of the structured network that, you know, together made a lot of strides to help clarify the corporate disclosure landscape through, you know, work with CDP, CDSB, GRI, IIRC and SASB. Those final two actually merged into the Value Reporting Foundation that you will see is part of the group of the platform itself. But you know, that only speaks to disclosure. And I think a key message that I just want to leave with you is that disclosure is very important. There's been a lot of attention paid to that, but you know, as I think just through the example of the Impact Weighted Accounts Initiative, this isn't just about disclosure. You can't have good disclosure without good impact management, and without good disclosure, you can't have good data in which you can compare. And so these organizations that you see that were part of the structured network, they talk to the entire set of impact management, which is why we use that broader umbrella term. So that's who the organizations are. They were facilitated by the Impact Management Project, and they themselves realized that following the what we called the sunsetting of the Impact Management Project, it was a time-bound initiative. these organizations, and credit to them, they recognized more work needs to be done here. You know, we have made some really important strides, but in terms of really clarifying this entire system for all practitioners, we've still got a lot more to do. And so that's why they have set out to work together. This was at the time of launch, we also brought on Capitals Coalition and UNDESA that are mentioned here. And you know, we do work very closely with Rob and the Impact Weighted Accounts Initiative that was introduced to us through the GSG as well. Just one little bit here on governance before we move forward. I think what's important to say is obviously the former model of collaboration was externally facilitated, but you know, there was an element of handing the reins over to the platform, what we call these organizations partners. And in order to do that, we wanted to set up a steering committee, which comprises several of the multilaterals that you're seeing here. So the International Finance Corporation, the OECD, UNDP, UNEP-FI, and United Nations Global Compact. And then it was UNEP-FI and OECD that came forward to say, we would like to co-chair this initiative, which basically means providing the team and the specific resources to you know, have this as a day-to-day set of operations. And so, yeah, so this is who they all are, speaking to you know, various pockets of the market, but what is it that they're doing together? So this slide here, which you will see replicated on the website, really just outlines the objectives that they're working towards together. So very quickly, that's through clarifying the meaning and practice of impact management, largely through a website that articulates the different actions of impact management common to any organization, investor, or financial institution, and also signposting to the different resources that will help you on the way. But we'll do a quick demo of that in a moment. They're also working towards interoperability and filling gaps as needed, which really can only be solved through a collaborative approach between these organizations. This is not just something that any one of these organizations could just go off and run with. It needs to be in collaboration with, you know, the other partners where appropriate. And the final thing is to have coordinated dialogue with policymakers. And really that's to say that where the platform partners produce content together that is, you know, relevant to that broader landscape of regulation and policy, we have those links there to ensure that those, I guess, good products, if you will, can be fed back to those that are setting the policy and regulation. Next slide, please. So this is just to say we've got those three objectives, they're super important, but how do we carry those out? So we have 3 sets of content-led work streams that is looking at 3 specific areas. One is the iteration of actions and the landscape of impact management. So that's really looking at the website in particular. We've got a work stream that is laser focused on that. Enabling interoperability and related content development. So that's really saying, where can we look at existing resources of the partners, but also pipeline content to really understand where there are potential overlaps and potential to launch things together or even harmonize content together. And so there's so you know, one of the ways that we've been looking at that is that we surveyed the partners at the beginning of the year to really understand what was coming up. So then we can start to draw the links between how they might be able to work together. And then the third way is this is about addressing those gaps that I was saying, these ecosystem gaps, if you will. And that is through creating an R&D agenda. So specifically looking at, for example, industry classifications or the role of data and digitization. And so we've gone to select experts within the market that are focused on specific areas to understand, you know, where there is already work going on in this area, but also where there are opportunities to work together. So, and from that, an R&D agenda will be created. Alongside that, I'm not going to spend very much time on this. This is just to say that sort of building on the ethos of the impact management project that was very much consensus led, we really have to ensure that this platform is as responsive to the market as ever. And so we want to, you know, have a set of ongoing lines of communication, if you will, both through the platform partners, but also the platform itself. So that's taking feedback, you know, as I said, bringing experts in to respond to the R&D agenda, for example, and making sure that the platform and the partners themselves are using this content to engage with their own constituents. And then the final weird box here, if you will, is just to outline the different areas of policy that we have so far been engaged with, certainly not exhausted, and there's many more areas in which we can feed into. On to the next slide, please. Thank you. So this is just a snapshot really of our website, which really corresponds to that first work stream, the iterations and the clarification of the actions of impact management. And so the goal of this website is essentially to make impact management as a practice as easy to understand as possible, and as easy to access the different standards and guidance that are available to support that practice. So you'll see that each of the different actions here that you'll just see on the bottom right there, that outlines the actions, but then they're there to signpost to the relevant resources as well to carry out those different actions. This is quite a big week for us because we've got the organization's actions currently live on the website, but as of Thursday morning, we'll be releasing guidance as well for investors and financial institutions. And there is actually, if you're really keen on webinars this week, there is another webinar that will actually take you through the different guidance as well. And so I will post a link to that if you would like to join that as well. I'm just sorry I couldn't cover it today because currently it is under embargo, but you'll see how it's going to play out when I take you through the short demo. But just one last slide I wanted to leave you with before we go into this demo, and that's just to explore a little bit more the actions of impact management. And so you'll see here the distinction between internal actions versus those that are more external facing. So from what you see from governance, strategy and management approach to setting and revising your objectives, identifying sustainability topics, measuring that sustainability performance, assessing that impact, is it sustainable in a given context, estimating value created, which obviously builds on the presentation that Rob just gave, verifying that, which is basically seeing if you can assure the data that you have been collecting and assessing, and then using that data to integrate and act within your own organization. So they set out specifically for organizations, those core actions or practice, let's say, that an organization could carry out. And then you obviously have, as I said before, disclose, which good disclosure comes from good practice. And then using that, that information that you disclose and the information that you collect, you can also benchmark that performance as well. Just some three sort of, I guess, lines of advice that were created when we put this slide together. Firstly, this is a mental model and it's not a sequence. This is a very iterative process. We purposefully didn't set it out as a linear thing because this is something that you might want to skip round. You might not necessarily need to delve into a specific action before you've gone to another, or you might need to go back or repeat an action. It's very much not a linear process in that respect. But the point was pulling these all together to really make sure that each action itself is explained as technically simply as possible, if you will. The second point is that these actions should be integrated with and not distinct from an organization's financial and operational processes. This is not about having a bolt-on CSR process. This is about having impact management fully integrated into a company's governance, its strategy, and its management approach, so that they can integrate useful information and act accordingly. And then the final thing here is to go as deep as you need on each. There is no bottom, which basically means that you cannot complete the actions. There is always going to be new information, new things that come to light, new reporting requirements, new data to benchmark. And so kind of in response to that first part that I was saying, this is an iterative process. You will have to go back to this. You can very much, with the different resources that are available as well, we really hope that there is kind of no end to this exploration as you carry out your impact management. Right, I think from there we will do a website demo. So why don't I share my screen now? How are we doing on time? Do I have 5 minutes? Is that okay? Yeah, cool, okay. Great. Right, so hopefully you will be able to see the home screen of the Impact Management Platform website, which importantly can be reached at impactmanagementplatform.org. The homepage here really, that was weird. Have you got a white screen as well? Well, that's embarrassing. Let's just try that again. It's never done that before, so I would choose to do that during a webinar. Okay, so here is the homepage, which really just explains what the platform itself is, how to use it. So this is really talking about choosing a starting point. Are you looking at the at actions of impact management for organizations or for investors / financial institutions? You can then explore what those different actions are that correspond to those different groups and build your own resource list, which I will also take you through shortly. And then this is just to outline who the different organizations are that are involved. So let's get started, which is going into the organization's actions. And as I said, the investments and, the investor and financial institution set of actions will be made available from Thursday if you click on this link here. But at the moment, I'm just going to take you through a little bit of this wheel, if you will, or the different actions of impact management, which you'll see now is interactive. And so the whole point here is that each of these different segments will lead you to a specific page that explains in detail what is involved and what are the resources available. So if we say, look at identify sustainability topics and click into that action, you'll see that each of these pages are set out according to the overview of the action. So really an explanation of what is involved, the different resources, but also the different definitions that are used, which is available at the bottom of the page. And another thing on definitions, we have a set of key terms and concepts here that all of the platform partners agreed to for the purposes of publishing this website. And they are all, where they become apparent, you'll be able to find them in the underlined wording here, and it just explains what the different definitions are that the platform partners work towards, but also specifically where does that definition come from. And so I'm just going to take you very quickly through this particular page. This one in particular has a set of interactive diagrams to take you through different materiality concepts and how that might be applied to when you're identifying your own sustainability topics, whether or not you're looking at them as value created for the enterprise, well, value created or eroded for the enterprise, or value for the a wider group of stakeholders. And so, yes, so this provides a little bit of information as to what is required of each action. And then here we have a set of resources that enable that practice. And so I mentioned before that there is a resource list, and obviously there's quite a lot of resources available, and you might want to say go to that resource directly. So if you clicked on, for example, the EU taxonomy, it would take you directly to that document. Or if you wanted to come back to it and save it for later, you would just click the star, and then you'll be building out your own resource list. Just another thing to say as well, each of the resource cards has a bit of, I guess, an overview of what each of them comprise, but they also provide guidance as to how they can specifically be used for any of these actions. So take, for example, the SDG Action Manager. It isn't just applicable to identifying sustainability topics. It could also be helpful to when you're measuring your performance, assessing impact, or benchmarking performance as well. And then just to show you at the bottom of the page, apologies for all of the scrolling. In fact, oh yes, here we go. And then this just lists out all of the definitions that you would have seen highlighted in the page above. Very quickly, I would just take you through the resource list. So this is just to show you the catalog, if you will. So all of the platform partners have fed in their content to provide this comprehensive list of resources. There are currently those that are also available to investors and financial institutions, just obviously not yet mapped to the investor or financial institutions actions, but it will be done so in literally a matter of days. And so you will be able to see whether or not these correspond to organizations or investments, whether or not these resources pertain to a specific action. Sorry, that's the action. You could break them down by resource type. So if you're specifically looking at principles versus metrics, you can do that through here. If you wanted to look at a topic focus, or if you wanted it to not necessarily be focused on a topic at all, you could select topic agnostic. So this is really, as I said before, this is about just finding the guidance that practitioners need as easily as possible. Remember I said that you could star those resources. Well, if you go to favorites and toggle that option there, you'll see that I favorited the EU taxonomy just then, and a few others I had done so earlier on. And so this just enables you to build up your own resource list so that you can come back to it and perhaps compare what you need for a specific action or purpose. And then just finally, there is an about page that just takes you through a little bit more about the impact management platform, some videos on key concepts, a copy of the launch webinar as well. So just in case me talking isn't enough, there is some more there that will hopefully provide you with a bit more information. But I think that's everything from me right now. I will send you the link to that event happening next week, and obviously we'll be very pleased to take questions later on.
Thank you, Joe. Very much looking forward for the investor part of the platform. I have to say that facilitating the collaboration between all the standard setters is by itself heroic, so well done. And last but not least, we'll now hear from Igal, who will share with us Sustainalytics ESG risk ratings. And Igal, it would be great to hear from you how you source and make sense of all the ESG data, and how you see that the convergence of data leads to action.
Sure. Thank you very much for the introduction, and thank you for the opportunity to speak about our rating. I must say that being the last speaker gives me sort of an advantage that the previous speakers already covered some of the aspects that I wanted to cover. So that's a good starting from me. So thank you for that. I'll share my presentation. Great. You can see my screen, right? Perfect. So just a brief introduction to Sustainalytics. As you probably know, there are different players that are in the ESG field. Probably one of the most important players are the ESG research and agencies that collect the ESG data and analyze it for different purposes. Sustainalytics is one of them, is an ESG and corporate governance research, ratings, and analytics firm that supports investors globally with the development and implementation of responsible investment strategies. We work with asset managers, asset owners, corporate clients. Again, globally, we have today about 1,000 employees around the world, different offices. Almost half of them are part of the research units that are located in 17 countries. As I mentioned, we have two types of clients, corporate clients and investor clients. To each type of clients, we have different services that we provide. And I'm part of the corporate ESG insights team that is focused on the corporate solutions. And though the client is the corporate, we still are very much influenced by the financial institutions' point of view, what the investors and lenders want or need to know. And my team that I'm part of is responsible to provide insights for corporates on their ESG risk rating, which is a bit different than impact covering. But Joe also covered this in her presentation. So there are different challenges for investors to understand ESG data and how to collect all this data and make sense of it. First, and most important, the data quality, the availability of data, the quality of it, to make it consistent and clear So this is one challenge that investors are facing. The second one is the financial materiality, how to make sense of this data, translate it into meaningful insights, and to understand the financial materiality of the ESG issues that are relevant to a specific company or a specific industry. And then we have the standardization, how to be able to compare companies from different industries within the same portfolio, how to be able to take a mining company and to compare it with a real estate company, for example. That is true to impact, that is true to risk assessment, and stakeholders want to understand how those factors create financial risk or how they create impact. Traditional assessments usually do not focus on those risks or on materiality, and this is why what I'm about to show you, the risk rating, Sustainalytics risk rating, actually does cover those aspects. It is important to also emphasize that these rating is keep evolving as the landscape of the ESG information is still evolving and improving. And we have new understandings of indicators and assessments. We also improve our data collection and the reporting requirements that we ask from or we expect from clients, our corporate clients, not only clients actually, for corporates in general. And we see more and more investors that are also interested in the impact. So I will address this briefly at the end of my presentation, as this is a new service that we introduce also for impact reporting. So the ESG risk rating measures the degree to which a company enterprise value is at risk, driven by ESG factors. This is what the ESG rating is about to cover, covers, sorry, and it has different its main key features include 5 risk levels going from negligible, medium, low, medium, high, and severe. It is comparable. That means that basically we can take companies from different regions and different industries and put them on the same scale, creating a single currency, if you may, to measure ESG risks. We cover around 13 to 14,000 companies globally, so we have high coverage. The data is accessible and the methodology is transparent, so you can download our methodology on our website, and also you can access all the companies that we cover in our risk rating website, so you can have the high-level information. If you subscribe, you can have some more information and more data points on companies. And I'm going to cover also in more details the 3 building blocks that we have for the rating, basically, which are the corporate governance as the foundation for everything. So all companies that we cover, we assess them on corporate governance pillars to some extent. Then we have the material ESG issues that are assessed on 2 dimensions: exposure to those risks and how the company mitigates these risks. So the materiality is set on a sub-industry level. Based on the sub-industry, the company is assessed on specific topics, and the level of exposure is adjusted. So if we start from a sub-industry exposure based on the sub-industry characteristics, then we modify or do the fine-tuning to the specific company level based on the company's characteristics. So it's also granular. Then we have the controversies that are another building block. Basically, the rating is sensitive to black swans, to other events the company is involved in, and we pick up those events daily. So even when we finish the assessment on a specific company, we don't wait for the next year to come. We keep monitor the company for any involvement in incidents based on the issues that are relevant to the company. And if those issues are not relevant as part of the regular assessment, but they are severe, then we will include this in our coverage. Finally, it's a comprehensive framework. So we have over around 20 MEIs, more than 400 indicators, and over 1,200 data points that we collect. And we use those data points, by the way, not only for the risk rating, but also we aggregate this to other services that we provide. One of them is also the impact rating. So if you want, basically, that means that we take the context and we take the indicators, and by putting them in a specific methodology or applying a specific methodology, we can also derive or flag to investors the impact of a company operation. So here, basically, you can see the two dimensions that I was talking about: the exposure, the vulnerability of a company to ESG risk, and the management, how well the company mitigates these risks by putting up policies and programs in place. So here you see on the screen the three main building blocks. So you have the corporate governance. As I mentioned, we have 6 pillars for the corporate governance that we assess all companies. I'm sorry, that we assess the listed companies, and 1 pillar of stakeholder governance that we assess non-listed companies. Then we have the material ESG issues, as I mentioned, based on their sub-industry, and their level of exposure is set on a sub-industry level. Then we apply betas, that basically those are the flags to do this fine-tuning to the company level. And then we have the idiosyncratic issues. As I explained, these are the black swans that the company might be involved in. So how do we do the assessment? How do we come up with a risk rating result? So first step is setting the scene. Basically, we understand what is the environment in which the company operates by assigning the company to a specific sub-industry, understanding the exposure level of the sub-industry, and then we assess the specific company's exposure. We determine what can be managed and what cannot be managed. To give an example, if we talk about the airline industry, we still don't have the technology that will allow us to eliminate emissions completely. So this portion of the risk cannot be mitigated, no matter what airline industry will do. Then from this portion of the manageable risk, of the potential of the risk, we actually check what the company does by setting up those policies and programs in place. And we check what is, or we calculate what is the managed risk. Then we deduct this managed risk from the starting point from the company's exposure, and we come up with the final unmanaged risk, which is the risk rating. So you can understand that the lower the risk is, the better the result it reflects to the corporate, but also to the investors. Now, another thing that I want to mention, and this is also important to understand, that when you do this calculation for each material ESG issue, and then you sum up all the specific scores for the MEI, for the material ESG issue, you come up with the contribution of each MEI to the overall risk rating score. So the contribution will probably show you where are the major gaps that the company has. But on the other side, when you take a look and you calculate what is the management score weight of each management score for each MEI, you also understand where is the most or where is the impact of the company on its result. So when it can do better and improve the most efficiently its score or its risk rating or its risk mitigation. Now, one thing that I like about the risk rating is not that it's only about that it's not only about the numbers and the quantitative information, but also having the context, having qualitative information and data that will provide the corporate and also the investors the understanding the characteristics of the exposure and management of the sub-industry that the company belongs to and the specifics of the company. So that kind of helps to analyze or to read the data and to make sense out of it, right? To understand what the company does well, where the company lacks, what is missing based on best practices in the market, and what expectations we have or by investors and financial institutions. I mentioned I talked about the controversies or the incidents involvement. You can see here that we cover around 80,000 sources globally, daily monitoring daily all our companies that we cover, and basically when we pick up incident, our analysts review this and determine what is the severity of the controversy based on the risk that it imposes, based on the impact that the controversy has on whether on social aspects or environmental aspects or governance aspects, and also how the company managed this controversy. Based on these pillars or those three aspects, our analysts determine if this is a low category or a severe category controversy, and for more severe cases going from 3, 4, and 5, we also set the outlook. How do we perceive the next 12 months would look like? Is the company going to upgrade the category or downgrade? And here, basically, as I mentioned before, you can understand that when you put everything on a scale from going from the exposure going from high to low, and the management going again from weak to strong, you can see that this is the coverage of our universe, and you can put all the companies on the same scale, and to be able to compare those using this currency that I was talking about. Companies might have different starting point, which is the exposure, but it allows us to benchmark the management performance of the company. How much of the risk implied by the company's exposure to an ESG issue is actually managed by the company. Now, how do we do that? We have the annual update. We update the management indicators based on companies' disclosures, websites, annual reports, sustainability report, etc., and also through companies' engagement. So companies are invited annually to provide feedback and additional disclosure to make our assessment more accurate. Then we have the corporate governance indicators. Also, this is only and solely based on companies' public disclosure, and that can be websites, annual reports, filings, corporate governance policies, etc., etc. But it has to be publicly available, given the importance of the corporate governance. Also, for the management indicators, it is important that some of the indicators we do require that the disclosures will be publicly available. And you can see here basically the process. So the company, we collect the data from the company. Also, we take media and news sources into consideration, NGO reports and such. And then we ask for the company's feedback. And by the end of this process and the collaboration with the company, we publish the profile of the company, and it goes to our website, where you can find, as I mentioned, all the companies that we assess with the high level information. You can filter by industry or by rating category. It also goes to our investor platforms and to our corporate platforms. So how it can be used, or what action can it lead to? So from the investors' point of view, obviously it can lead to ESG integration in investment decisions, to screen or to benchmark companies, to support the impact investing by using these data points, also for the impact reporting service that we have, and I'll briefly talk about this in the next slides. And also for proxy vote, for proxy decisions, voting, and engagement with shareholders. And for the corporate clients or corporate points of view, sustainable financing, access to capital, banking solutions with better terms for clients. We also see many companies use it for marketing and promotion purposes, which is quite clear. They want to companies want to differentiate themselves from their peers. Also to engage with investors on their performance, and but it's also for internal use when we see companies that link between their ESG risk performance to remuneration or to corporate KPIs. Now, briefly, I'm going to talk about the new service that we are introducing, which is the impact metrics that include the impact framework. Basically, that is based on 5 pillars or 5+1 impact themes that you can see on the screen. Each one of these themes are linked to SDGs. These are high-level categories that are most relevant for the financial and business sector, streamlined with the SDGs, and it offers flexibility to choose the length that works best with the financial institution impact focus. Investors need a consistent way to evaluate the broader impact of their investment on the world. It is complicated, as Rob mentioned in the beginning of the session. It's much easier to understand or to put a number under the risk, but it's much more difficult to understand the impact, or to make it concrete and to put a number for the impact of a company. So you can see here that our impact metric is a quantitative measures of environmental and social outcomes that is based on the indicators, as I mentioned. It's sourced from the issuer reporting, from the corporate reporting, third-party providers, and derived by combining metrics that we use. So different indicators that we combine together to create this metric. And it is based on a specific year, fiscal year. We have 47 metrics that are part of this framework, and it can be either service product linked to product and service metrics, or operations metrics. You'll have this also in the presentation that will be shared with you. So I don't want to take more time to discuss this. And this is from my side.
Great, thank you, Igal. Perhaps we'll start with a question for you. We have a question in the chat. If you can speak a little bit about the company profile that Sustainalytics is most suitable for in terms of company size, etc.
Yeah, so we cover different types of companies. We have two different frameworks for companies that we cover. Companies with higher market cap and higher, like a more big profiles. Then we cover them with a comprehensive framework. It's much more in depth. Smaller companies, lower profile, lower market cap. We assess on a more fixed framework that is the core framework, without going into the MEI level, the material issues level. But we have a way to align those two frameworks so we can put all companies on the same scale. So whether they are core or comprehensive. Companies that acquire license to be assessed and to use our analysis and research, then they receive a full research, comprehensive research. So we do see companies that are big, but also SMEs. In terms of private and public, both we have both on the assessment, because some companies want to be able to get investments regardless if they are listed and traded.
Interesting. I think in a way, Joe, this question also can be extended to the platform. Do you see, I know the impact management project or the 5 dimensions in a way were applicable from startups to real estate investments to private companies and perhaps even public companies. Do you see the platform, the organizational part of the platform being used also by these types of companies and organizations, or is it more targeting corporate companies?
Very much meant to be covering all types, which is why, like I saw one question actually in the Q&A sort of saying, like, is there any way to sort of be advised on like the right resource for me? And the simple answer to that is no, is because this is meant to encompass the entire spectrum of all types of organizations, all types of investors and financial institutions. And, you know, it's only that way that I think that the partners themselves, and I certainly agree with, believe that that's how you mainstream, right? Is that there has to be this like commonality across the different actions. So yes, that's why there is an extent to which it remains high level. As we look at adding more resources, we might go more into specific topic areas. There will be some that sort of build out for more specific sectors as well, over time where it's appropriate. But certainly the partners that are involved at this point are there to sort of cover the kind of, are there to be more or less agnostic in that respect.
Great. Rob, perhaps a question for you. I think we all see the development of the integration of impact and financial measurements. I think perhaps most noticeable is the IFRS announcing its sustainability board. What do you think are still the main barriers or challenges for impact-weighted accounts to become, I would say, widely adopted and that we'll see it in actual financial statements?
Yeah, there's still a little bit of a debate, right? So the ISSB doesn't have actually impact right now, right, as part of its mandate, right? And we're still sort of in this debate right now within the United States, right? That I'm currently like head down in a comment letter to the US Securities and Exchange Commission, right? I'm also participating in a letter to the ISSB. There's this, frankly, I think, and a lot of other people think, there's this false distinction between financial materiality, right, and sort of double materiality. I think it's completely false, right, that you can operate at odds with a stakeholder group, right, especially in a world where everybody has a camera phone, right, and a tweet can go viral in, you know, minutes or hours, right? I don't think you can really mistreat your workers or your, customers or do things like that. You are effectively maintaining the difference bets on time, right, as well as sort of stakeholders continuing to have a lack of agency. So we are still living in this world, right, where the ISSB and the SEC, right, their mandate is to provide information that is material to investors, right? And so, again, I think there will be a collapsing of that, right, in the next few years. But I think until then, right, there's a little bit of education that needs to be done on how those issues do turn out to be material to investors. What I am encouraged about is a number of these standards have a show your work element to it, right, which basically says, how did you determine these were the material elements, right? And so in order to really do that in a comprehensive way, I think you actually have to do a full materiality assessment, right? And then substantiate why some of those issues are not material. So I think that's a difference. I don't think it's one that's insurmountable. That's where we're focusing a lot of our work on research, right? On how these broader issues are material to investors, how materiality is dynamic. So we're tremendously encouraged, actually, I'll say, by the work happening with the ISSB. And frankly, even in the US context, the SEC, many people might say, oh, it's not perfect. It is such a huge improvement, right, from what has been there before, that it really should be viewed as a step forward.
Interesting. I think definitely it's more about dynamic materiality than anything else. I guess perhaps to specify the question, it's about monetization. Do you see monetization of impact becoming more and more adopted, or do you think we can see, the costs of externalities embedded in financial statements anytime soon?
Yeah, I really hope so. I think that we've already heard from a lot, and we are working on sort of a broader view of the case study, right? We've done probably half a dozen, no, not half a dozen. We've done 24. I divided by 2 instead of multiplying by 2. We've done at least 24 pilots with companies that are beginning to use this in their internal decision-making, in their board reporting, etc. Value Balancing Alliance is another fantastic peer organization focused on this issue. They've done a huge number of pilots. I think that we are getting closer. I think frankly, we will see sort of voluntary disclosure. So we are already seeing voluntary disclosure by some companies on their impacts. I think the biggest hurdle to getting it actually incorporated in financial statements is companies getting comfort that the regulators aren't going to say, wait, what is this then, et cetera. And so we have a little bit of work to do with the audit and the assurance community as well, because until they are on board, and they are, right, there's a lot of movement among, the big 4 on this. But frankly, we're seeing alignment around, sort of research agendas. CPA Canada is looking into this. So there's a whole, I'm being a little scattered because that's how it like exists in my mind, but it's also incredibly exciting because there's a lot of momentum around it in various pockets in the world. And so part of my job is doing a little bit of coordination of that.
Interesting. So I'm looking at thank you, Rob. I'm looking at the Q&A chat, and I think you've answered most of the questions live. So I guess we can wrap this now, unless anybody else have any other question, ask now. And I would like to thank all of you for joining us today, and for promoting the field and for your important initiatives, and for the IFIE and KAYAMA Center for organizing this webinar and the course. And thanking everybody. Bye, everyone.
Thank you all. This was so wonderful.
Thank you very much.
Bye.
Bye.
Thank you, everybody.
Thank you for joining.